Okay, hello everybody and welcome back to our next session. My name is Aoife Lucklin. I'm a policy analyst in Task. So our next topic, tax havens and tax avoidance, has been generating an increasing amount of international political and media interest over the past year or so. A large amount of this interest has recently focused on Ireland and the role our tax system plays in facilitating tax avoidance. Our next speaker is one of Ireland's leading researchers, writers and commentators on the topic. Professor Jim Stewart is Associate Professor in the School of Business in Trinity College in Dublin. He has also taught in the Robert Schuman University, Strasbourg and Birkbeck College, London. His research interests and publications include foreign direct investment in Ireland, the financial behaviour of multinational companies, regulation of auditing, financial regulations, corporate taxation and pensions policy. We are delighted that he could join us here today to address the question, is Ireland a tax haven? Professor Jim Stewart.
So thank you for inviting me here to talk to you about this topic today. Solutions to the economic crisis and sustainable economic recovery are often seen in terms of tax reliefs, especially for the corporate sector, and this is especially so in Ireland. The Google appearance before the Public Accounts Committee in the UK and the report of the US Senate on offshore profit shifting in Apple Computer resulted in considerable media coverage and have led to widely reported view that Ireland is a tax haven. And this is the subject matter of my presentation today. A country, I will argue, a country that seeks economic success and a strong industrial base is unlikely to succeed by becoming a tax haven or developing features of a tax haven. If Ireland is not a tax haven or does not have tax haven type features, then being classified as a tax haven has resulted in a severe reputational and economic damage. So either way, this is an important topic. To recap, Google has substantial operations in the UK, employing 1,500 and generating 18 billion in sales over the period 2006 to 2011. Yet just 16 million was paid in corporation tax in this period. The UK Public Accounts Committee concluded that Google defends its tax position that claiming that the sales of advertising space to UK clients take place in Ireland, an argument which we find deeply unconvincing on the basis of evidence that despite sales being billed from Ireland, most sales revenue is generated by staff in the UK. It's quite clear to us that sales to UK clients are the primary purpose, responsibility of its UK operations, that the processing of sales through Google Ireland has no purpose other than to avoid UK corporation tax. A Google subsidiary in Ireland, Google Ireland Holdings, accounts for 92% of non-US Google sales. Google Ireland sales for 2011 amounted to about 12.5 billion, but resulted in pre-tax profits of 24 million, largely due to an unexplained payment referred to as administrative expenses of 9.02 billion. This is likely to be royalty payments paid to its parent Google Ireland Holdings, an unlimited company, which is registered in Ireland but administered from Bermuda, the famous double Irish. Google operations in Ireland are central to Google's non-US operations and to its tax strategy. The Apple case. The US Senate report on Apple Computer groups Ireland along with Bermuda and the Cayman Islands as a tax haven. The report states that Ireland has essentially functioned as a tax haven for Apple, providing it with minimal income tax rates approaching zero. This led to a letter from the Irish ambassador to the US denying that Ireland was a tax haven, and this in turn led to a response from Senators Levin and McCain, which stated that most reasonable people would agree that negotiating special tax arrangements that allow companies to pay little or no income tax meets a common sense definition of a tax haven. So the letter from the Irish ambassador to the Senate subcommittee is on the Department of Finance website, so you can view it there if you want to. The debate about whether Ireland is a tax haven and the response by the Irish government to the memorandum from the Permanent Subcommittee on Investigations is of considerable interest from a public policy perspective. It sets out government policy in relation to whether we're a tax haven or not. The Irish ambassador obviously took considerable guidance in drafting and writing this letter. In this letter, the Irish government argued that Ireland is not a tax haven because, one, there is no possibility of individual special tax rates being negotiated for companies. Two, the tax rates calculated refer to the company's entire profits as if those companies are tax resident in Ireland, and concludes the tax rates attributed to Ireland are wrong and misleading. Secondly, they argued none of the four indicators developed by the OECD apply to Ireland. Both of these responses, I think, deserve careful analysis, and that's what I want to do in the next few minutes. The Senate report makes several references to the tax rate faced by Apple Sales International, one of the subsidiaries in Ireland. The other subsidiary discussed in the report, Apple Operations International, has no declared tax residency in the world. So in contrast to Google, Google claimed it was tax resident in Bermuda. Apple Operations International is not tax resident anywhere. We said we're not actually tax resident in any country. In an opening statement, Senator Levin states, Apple has quietly negotiated with the Irish government an income tax rate of less than 2%, well under the Irish statutory rate of 12%, as well as the tax rates of other European countries and the United States. The Senate report also quotes a statement from Apple that since the early 1990s, the Government of Ireland has calculated Apple's taxable income in such a way as to produce an effective tax rate in the low single digits. The rate has varied from year to year, but since 2003 is between 2% or less. While the Senate report refers to a tax rate and a special tax rate, it is clear from the quotation from Apple's submission that they're referring to the effective tax rate and not the nominal tax rate. So they're talking about the effective tax rate, not the nominal tax rate. The Irish government responds saying that we don't change our nominal tax rate, that's set in law, and that's true, that's set in law. It's the effective tax rate is the key issue. There are many other examples of companies operating in Ireland with low effective tax rates. An aggregate data for US firms shows an effective tax rate of about 4.2% on some measures for 2008. In relation to the second point, the Irish government's position is that companies such as Apple subsidiaries are not tax resident in Ireland. And this position is supported by Apple, who stated in a submission to the Senate committee that although both subsidiaries are registered in Ireland, they do not meet the requirements for tax residency in Ireland. So the Revenue Commissioner's treatment by these companies as not being tax resident in Ireland has considerable policy implications, which I dealt with in an earlier paper. It has implications also for revenue statistics relating to corporate tax payments, because if they're not tax resident in Ireland, the revenue omit these companies' profits in producing an estimate of the tax base for Ireland. They would, of course, be included, these companies would, of course, be included in CSO data, sensitive industrial production, and, of course, in employment data to the extent that they employ anybody, and that would, of course, be included in IDA numbers as well. So it's useful to consider why not being tax resident in Ireland is controversial. The Senate subcommittee described such arrangements as an absurdity, one that we have not seen other companies use. Elsewhere, the Senate report refers to the alleged status as a non-tax resident. The tax strategy followed by Apple and other companies has been described in numerous media reports as the double Irish, and sometimes in a closely related tax strategy as the Dutch sandwich. So that's for years. This has been referred to by Bloomberg, New York Times, and all sorts of other media outlets. The nub of the tax strategy arises from differences in what the US defines as resident for tax purposes, and that is where the company is registered, where it is incorporated. And the rules used in Ireland, which use a management and control test. So the revenue say, look, on a management control test, these companies are not operating in Ireland, they're not tax resident in Ireland, even though they're registered here and even though they're incorporated here. The country where a company is registered and incorporated is generally recognised as its legal home. So a key part of the Revenue Commissioner's case for these companies not being subject to Irish corporation tax is under Irish tax law. Although registered in Ireland, they are not managed and controlled from Ireland and hence are not tax resident in Ireland. Hence it's interesting to examine available published evidence, that certain subsidiaries of companies such as Apple and others can claim not to be managed or controlled in Ireland. So from earlier research, I identified a number of companies that used a bilocation strategy, in that the firm itself or its parent was bilocated. So Google Ireland Holdings is not bilocated, but its immediate parent in Ireland, Google Ireland, is bilocated, located both in Ireland and in Bermuda. Some of the companies pay other taxes in Ireland, such as VAT, some of the companies in my study, and they pay PRSI. So if they pay VAT, they're liable to pay VAT. They're certainly resident in Ireland for VAT purposes. They collect PRSI and they hand that over. So the revenue collects PRSI. So on certain persons, they are tax resident. Hence, it is not correct to say that the companies concerned are not tax resident in Ireland. They are tax resident in Ireland for some tax purposes, but are not tax resident for corporate tax purposes. Secretarial services are in most cases located outside Ireland, where the company is located, for example, Bermuda. In a number of cases, secretarial services are stated as being provided by an independent firm. These are not employees. So if you're a secretarial service are provided in Bermuda by a firm that specialises in this, these are not employees in Bermuda. There are no employees in Bermuda or anywhere else. The latter point is important because it is difficult to argue the location of secretarial services offshore as being the main criteria for deeming a firm to be managed and controlled offshore for corporate tax purposes. In all cases in the study I looked at, bar one, company records are not located where the company is deemed to be managed and controlled, but are deemed where they are located where the registered office is, or where their parent company is located. So in company records, the annual report and accounts say they're either in Ireland or they're in the US. In all cases, of course, the auditor of these subsidiaries is located in Ireland. So the auditor is not located in Bermuda or whatever. So that just gives the table some features. One company in particular, Synopsys, claims that it operates from Bermuda. So I just got a little photograph there from Google Maps. You can't get Google Street View of Bermuda, but that main building there is where Synopsys says it's located and operates from. And the same building houses Google, parent, and Microsoft, and lots of other companies are claimed to be located in this building, and the revenue regards them as being located here. Secondly, I want to deal with the OECD criteria. So the OECD have 4 criteria for classifying tax havens. And the OECD was requested in 1996 to develop measures to counter the distorting effects of harmful tax competition. They produced a report in 1998 and listed 4 factors used to identify tax havens. These are the 4 criteria referred in the Irish ambassador's letter that would identify as the country as a tax haven. And these are only nominal tax rates, lack of effective exchange of information, lack of transparency, no substantial activities. A report issued by the OECD in the year 2000 identified 35 jurisdictions as tax havens. Tax havens were subsequently classified by the OECD into cooperative tax havens that agreed to remove harmful tax practices and uncooperative tax havens. So all 35 said they were cooperative, 3 were not cooperative, and subsequently these uncooperative ones were taken off the list because they agreed to cooperate. In its most recent progress report, the OECD state that all countries have substantially implemented the internationally agreed tax standard, with one exception, which has agreed to implement the standard but has not yet done so. For these reasons, a country such as Bermuda can refuse to cooperate on a multilateral convention on mutual assistance, which David Cameron wants to introduce prior to the G8 meeting with the UK tax haven countries associated with the UK. And they maintain, Bermuda can maintain, in all honesty, we're already there on transparency. Our regulation is second to none. We are not a tax haven. So there are no tax havens as regard the OECD. So Ireland, the question, the response to the Irish ambassador letter say Ireland is not a tax haven, and the OECD criteria is what country is, and the answer is none. It's empty. There are no countries regarded as tax haven using the OECD criteria. The OECD has also listed key factors in identifying harmful tax regimes. And these are no or low effective tax rates, ring fencing of regimes, lack of transparency, lack of effective exchange of information. The OECD said that of 47 potentially harmful regimes identified, 18 regimes have been or are in the process of being abolished, 14 have been amended to remove harmful tax practices, and 13 have been found not to be harmful. There's only one regime, that's for Luxembourg, the Luxembourg holding company, that they said could be harmful. And Luxembourg argued, look, you've picked us out because you looked at financial companies, financial holding companies. You've ignored all other holding companies such as the Netherlands and Switzerland and whatever, and you focused on us, and that's just not fair. Hence, there is no country that meets the 4 OECD criteria of being a tax haven, and only one country that the OECD consider to have a harmful tax practice. This is at variance with other research. The US Government Accounting Office lists 50 countries, including Ireland, Luxembourg and Switzerland, as tax havens. The recent report by the US Senate Permanent Subcommittee on Investigations groups Ireland with Bermuda and Cayman Islands as tax havens. The Tax Justice Network identified 82 tax havens and offshore financial centres. Many countries have features of tax havens. The Netherlands, for example, has low rates of corporation tax on holding companies, and for some purposes the Netherlands is the largest tax haven in the world, followed by Luxembourg and followed by Ireland. And the UK exempts certain residents referred to as non-domiciled from tax on their foreign income. So a lot of the tax exiles from Ireland probably live in the UK where they benefit from this exemption. So on this basis, Ireland is not a pure tax haven in the classic sense. And if you wanted to just check out whether Ireland is a tax haven or not, just pull out a recent pay slip and look at the deductions, and I think you'd quickly conclude Ireland is not a tax haven. But it has features of a tax haven, and these are a low corporation tax rate, ease of incorporation, relatively light touch regulation, and tax and other legislation that is very responsive to the needs of multinational corporations. And it's the tax regime that operates in Ireland that is key, not the tax rate. It's this regime that we operate for allowing bilocation of companies and in other ways. This is key to Ireland's attractiveness for multinational companies. So in conclusion, Ireland is not and cannot be a pure tax haven. Tax revenue is needed to fund public expenditure on, for example, schools and hospitals. Tax incentives erode the tax base in a number of ways. To direct tax loss, which may or not result in higher tax revenues, through the use of tax incentives in unanticipated ways. Tax incentives interact with one another. They lead to they can be diffused to other sectors. They can lead to be used in unanticipated ways. This can be further exacerbated by lobbying by affected groups. As a result, tax incentives tend to diffuse both to other sectors and geographically. The net result is that the burden of taxation shifts to activities and individuals that are unable to avoid tax. It's the little people pay tax. The main influence on investment decision making is the possibility of making a profit. A primary focus on tax strategy is a distraction, and according to a survey and other evidence, is not a major determinant of investment. A tax-based industrial policy will not result in an innovative, research-led economy. A tax-based industrial policy leads to an emphasis on tax reduction. And the four big accounting firms, they had 24 billion in revenues in 2011-12 in tax advice, and that would include all assets tax advice. So it's a very, very large, very, very powerful industry. Those skilled in knowledge of the tax system become senior management. In turn, their skills require constant updating, and they become dependent on tax advisors. The dominance of accounting, taxation specialists in senior management positions is at the expense of those skilled in new product development, production expertise, logistics, and marketing. The tax avoidance industry in those firms skilled in understanding of the tax system and selling tax services become large and powerful and may exert considerable influence, as we see in Ireland, in formulating tax policy and legislation. Long-run economic success would not follow from countries introducing tax haven type features, of which a low corporate tax rate is an essential feature. Thank you very much.
Thank you very much for that.
University of London. I assume that the conclusion in policy terms from your talk is that Ireland should raise its corporation tax rates. I assume also that there must be some incentive for the government to maintain them at the low rates in terms of the fact that even though the percentages are very small, they're taking small percentages of a huge amounts of revenue because the companies registered here are very large. So if you raise those rates, then in the short term, you're going to lose those large companies to a degree. So what extent is there a trade-off in the short term between raising corporation tax rates and increasing revenue from what's left and losing the revenue from the companies which leave?
Hi, I think the policy issue, is the really important issue here. But we've seen in the debate here in Ireland about, well, in actual fact, there never has been a debate about tax policy. It's always been a one-sided debate, and it's only very much in recent months, with the hearings that took place in Washington and also the hearings that took place in London, we've even seen that debate beginning to raise in Ireland about people raising questions about the tax status of these multinationals without being shot down for being sort of anti-patriotic, for example. I don't think there really is a policy option here in Ireland, because I think it's an extremely immature debate that has only really just got going in recent weeks. But there are opportunities at the European level to regulate for these things, both in terms of the CCCTB, also in terms of regulations around financial transactions tax and the transparency of the financial services. All of the sorts of elements of these initiatives are deliverable at the European level, whereas they're not deliverable here in Ireland. And I'm wondering what you think about what that means for the quality of the debate in Ireland and the capacity of the Irish government to actually challenge some of these inequities.
Well, Sweeney, very interesting presentation, Jimmy. Two questions. One is, are you implying that the OECD is its criteria are a joke and they're there at the behest of multinationals? And the second question is, sorry, it's gone out of my head, just wait a sec. No, I pick it again.
I think the first question, listener, I think the point is the tax regime in Ireland important. It's not the tax rate. Okay, it's the flexible response. So every finance bill, every finance act has a string of measures that are extremely complicated to understand, and they're because they facilitate a single firm, or perhaps a group of firms, because they have run into problems with the IRS or HMRC or whatever. So Ireland has a very flexible, and this is through their own lobbying, their very close connections. You have to understand that tax revenue for large companies is dealt with the large case division. This is true of the UK, it's true of Ireland. And the large case division was reorganised in Ireland in 2005. The basic idea is you get a cooperative relationship with companies. This minimises aggressive tax avoidance and minimises expensive legislation and extensive court appearances or whatever. So that's the basic idea. So in Ireland, for example, in the most recent survey of this tax practice in Ireland, the Revenue Commissioner said that they found it necessary to invest in social skills for their senior employees. So what I always summarise that is that Garlic Man, if you remember the Garlic Man case, Garlic Man goes to jail, Google Man gets taken out to lunch. So it's a different tax, two different tax regimes. There's the rule-based tax regime for you and I and for small industry, and then there's a negotiated environment. So that negotiated environment is very, very important in Ireland. In relation to the tax rates, Ireland gets about twice as much revenue as a proportion of total revenue from corporation tax than France or the UK or other countries. So Ireland gets lots of corporate tax revenue. That's because there are huge ones flowing through. So one of Google's subsidiaries made 22 billion in profits. If you get 0.5% of that, that's a lot of money. So there's a lot of flow through. So if you increase the corporate tax, the effective tax rate by 1 or 2%, how would these companies react? How would they react? And that's something that you don't know. Would they shift the profits to some other location? I suspect it'd be difficult for them to do so because Ireland has very attractive tax features. Not the tax rate, that's the tax rate, but the tax regime, ease of incorporation, other things that are very important, double tax treaties. So I suspect you could increase the effective tax rate, and that would lead to an increase in revenues without a shifting of true transfer price in other companies. So in relation to the debate, yeah, I think the solution has to be harmonisation at a European level, because it's very difficult to tax profits of the new economy firms such as Google, all these other firms, Facebook, LinkedIn, and a lot of these companies are located in Ireland. It's very difficult to tax their profits except on a harmonised basis. And that is both a threat for Ireland because a tax change will be introduced which we have no control of. It's not in our gift. The French or the German or the UK or the US may change their tax rate that affects companies operating in Ireland. We can't control that. We may try to control it in some way, but we may not do so. But I think the point is, if there's less emphasis on giving tax reliefs, that's good. People want to think around how do we help industry, how do we create jobs with tax relief. Tax relief won't create jobs. Tax relief will lead to tax avoidance behaviour. The tax avoidance industry gets strong and powerful. You get tax jobs in the tax avoidance industry and then moving into new office buildings or whatever. So I think the debate in Europe is very good, and I think it will have implications for us, but there are also great opportunities for us. And in relation to Paul's question, are you saying that the OECD is a joke? No, it's too sad to be a joke. It's just the OECD. The OECD is the result of the policies produced by the OECD. The policy documents, statistics are extremely good, and I use them a lot. The policy documents are an outcome of bargaining between all these countries that get together. And I think Ireland is in there protecting, as they would see, Ireland's corner, and every other country is in there protecting their corner as well as they could. So I don't see much coming out of the OECD in relation to tax reform.
So another question that I forgot was, and you hinted at it there, is that we pay taxes according to the rules, but are you suggesting that that multinationals do deals with the revenue here in Ireland, as well as we know they do in England, from Richard Brooks's book, excellent book, exposes how the British just bow down to the multinationals. They do a deal, say, we'll pay 2 million we'll pay 2.5 million. Because if that's the case, are the government ministers and the ambassador lying to us because they're saying we have a transparent system? Then clearly if there's deal making, it's not transparent.
I think that because it's very complicated, reaching a tax, the amount of tax due from any multinational company necessarily involves negotiation. It has to, because it's extremely complicated. The problem is that the revenue and HMRC and the large case division in Ireland, they claim they're negotiating. It's very unequal negotiation because these companies have access to lots of tax advice. They may also say, if we don't get a tax concession, we'll move. So it's a negotiated environment. The other point is that a multinational company such as Google, if it decided to import garlic and it ran into a problem with the tax rate between apples and garlic, it would go along to the Department of Finance and the IDA and they'd say, look, we have a problem here, change the tax rate. The tax rate would be changed. So they wouldn't reach a problem back. They would never get into a position where they were in breach of the law. They always operate within the law. If they don't like the law will be changed. Not necessarily always in the way they would like, but to facilitate them as much as possible. And that's one of the main attractiveness of Ireland as a location, what the idea are. We have a very flexible response to needs of multinational companies.
Sorry, I was hand up third. Lorraine Mulligan is my name from SIPTU. I just wonder, is there any evidence about whether or if any of this tax revenue which lands up in Bermuda is reinvested, or to what extent it is reinvested by the likes of Google, etc., and how that happens, or is it just pocketed by a very small number of worthy directors?
Yes, the Minister and several other people have said there's nothing Ireland can do. You know, we got to wait for the European Union to do something. Just about every European country I go to has the same argument. The Germans say, can't release, can't stop wage restraint. We got every European. They're the big country. I think that the experience of the U.S. states shows that you don't have to have a low tax regime to have fast growth and employment growth, even if you're a small state. Vermont is the next example, has high employment, high taxes. So I just wondered, do you think, well, there's really nothing Ireland can do, we just have to wait for something from European level?
My name is Stewart from Christian Aid, and we are one of the agencies who have been working on this subject for many years. But we've been working at it from the perspective of the impact that these same structures and systems are having on developing countries, which is clearly much more profound and damaging than the consequences that we're facing in Ireland. One of the things that I wanted to ask Professor Stewart is, this idea of establishing blacklists for tax havens has been proved to be pretty futile, and there's been a number of attempts, and ironically it's generally led by the OECD, who are home to many of the more established or tax havens. I mean, what is the value? Do you see any value in trying to establish blacklists for what we prefer to call secrecy jurisdictions rather than tax havens? Because it's an ongoing attempt at the European level. Most recently they've established a platform on tax good governance, where one of the intentions of the action plan is to establish a blacklist. The French government have established their own blacklist, and so it goes on. And I wonder, these are very intelligent people who clearly see some merit in establishing a blacklist, but I don't always see the merit in that. And just finally, on the OECD, as you know, they're undergoing a process at the moment on base erosion and profit shifting. And they have acknowledged that the current system is broken, that the rules that govern international finance and regulation haven't kept up with the pace of business. What would you like to see them introducing as an alternative? Not that I have any great expectation that they'll introduce very progressive, but what would you like to see?
Yeah. First of all, the question about Google and cash and retentions. First important point to note is that Google does pay tax. In 2011, Google paid $1.47 billion in tax. And over 30 million of that was paid in the US. Google and Apple and all these companies pay tax in the US. You wouldn't think that from reading the Senate committee or whatever. It's not at 35%, but it's 11%, and it's way higher than they pay in India country. It's outside the US they don't pay tax. And that's the problem with Google in France and Germany and other countries. And I think the Senate committee and others there's a lobbying going on here. Google and Apple do very well. The US does very well from these companies. The tax rate in the US is very high, 35%. That means any expenditure in the US comes off profits at 35%. That's why Google has 17,000 engineers in California and they're not located in China or India or whatever. So I think there's a little bit of perhaps of misleading information or bias coming out. In relation to cash, all these companies are very large amounts of cash. Does that lead to increased investment? It doesn't appear to do so. It's important to note that the cash is not in Bermuda. Most of the cash held by Apple and Google and whatever is in the United States. Apple has about 40 billion in US government securities. Most of those cash is used throughout the group in various ways. So that's a debate about going on in the US about whether they should tax profits earned abroad, and that has other policy implications. I think I could just think, is there something Ireland can do? Ireland, as far as Ireland is concerned, Ireland wants to keep the tax incentives for companies. They think this is good. They think this is the way to achieve, give those companies as many tax breaks as they can get. That's what Ireland's strategy has been for years. Now, I think this is not good for Ireland. I think it's not good for other countries. But the Irish government and Irish state agencies policy, that's what they want. That's why they're so upset with Ireland being regarded as a tax haven. I think that there will be change, but the UK, HMRC and other tax revenue bodies, they say nothing can change unless everything changes. That's, I think, incorrect. The UK and other countries such as France and Germany can make unilateral changes, and I think that could happen in relation to Google operations, reclassifying sales, in relation to other social media operations. I think that the blacklists, I think blacklists are excellent for lobby groups. The problem is the blacklists don't work for the OECD because the OECD is basically reflects the lowest common denominator of what everybody can achieve. I think blacklists can work for an individual country and are very powerful in the US. The US Senator coming out and saying that Ireland is a tax haven. That has huge implications, huge reverberations. So blacklists can work, and the Tax Justice Network has done tremendous work on this, as have Christian Aid and other people. So I think blacklists can work. My point is about the OECD and its process. While I say that, okay, there is the base erosion, but the problem with base erosion relates to definition of transfer pricing. And there's a conflict of interest between different countries. There's a point about Google. Google does pay tax in the US, but there's a conflict of interest between Google and the UK and France and Germany. France and Germany said, we want Google to pay tax there. But the US said, we don't care whether you pay tax. If you're foolish enough to give them tax concessions, that's up to you. If the money comes back to the US, we hammer it for 35%. So, you give us, if you give tax effectively, it's repatriated, a gift from us to you. So we're happy with that.
I just want to make two comments. One comment in relation to Paul's question as to whether the Irish government is lying. I wouldn't be too surprised if that government's lying, but the issue I think is a little bit more subtle than that, because I don't think they're actually lying. I think they're saying things like, we're paying the tax, we're getting the companies to pay the official tax rate. The tax rate is 12.5%. It's what profits are declared at that 12.5% that is the flexibility. But if you look at the statement by the ambassador, for example, it's very careful. It's very careful about the rate being transparent, and the payment under that rate is transparent, all of which is true. It's, as Jimmy says, the regime, the regulation that is interpreted that is flexible and negotiated company by company. So it's not the Irish government that's telling lies, it's the flexibility that they're adducing to themselves from this liberal interpretation of regulatory regime that allows them this individual company negotiation. Another comment is a comment on the whole notion of this this low tax regime as the foundation stone for industrial policy since 1958. Is it a good thing that we have done, or would there have been a better alternative? There is no way to answer that question analytically, scientifically. You'd have to adopt a counterfactual history approach, and all economists know, and all social scientists know, that adopting a counterfactual approach in analysing a set of policies that were adopted in the past is counter-arguable, if nothing else. But if you do calculate the entire amounts of money that have been spent on subsidiaries and multinationals, including tax expenditure that was spent on, including advanced buildings that were provided, including capital advances that were given to them. And you took all that totality, which is many billions, and you said, okay, we're going to divide that money up among innovation policies, industrial development policies for indigenous firms, among SMEs and subsectors that have potential for development into internationally competitive groups. What would have happened? Would it have been better? Okay. Not answerable, but I think my view as an industrial policy analyst would be, together with Jimmy's, that this was not a good foundation stone of industrial policy, and at the very least, if some of that expenditure on subsidiaries and multinationals had been reorientated towards indigenous development, we'd be better off now.
In my opinion, I think we have eventually a problem in the way that taxes are collected on the national level, but corporations, and especially multinational corporations, are ruthlessly worldwide functioning. So if the US, if you're saying Apple, Google, and all these corporations, they are paying 35% in the US, for sure, because the US is strong, is united, is a federal state. But Europe is a European Union which has no tax harmonization, which has no common tax policies within the European member states, and therefore needs urgently to overcome this kind of situation, a harmonization of the tax regime in Europe, then we would have also a stronger position vis-a-vis these kind of multinational corporations. So the problem is not so, in a sense, in my view, what you're saying, and it's right, OECD has this list or so, but the problem is that we in Europe are stronger together, and then we can, together with the US, form a kind of a common, let's say also international tax harmonization policy, which excludes then also tax havens like the Cayman Islands or Bermuda Islands.
Ambassador of Finland, or the part of Finland, we are very happy that this kind of open discussion concerning tax evasion is going on, and just in May this year, a few weeks ago, Finland together with the European Commission organized a important seminar, the first in its type in Finland, and one of the findings in that seminar was that the European Union area is losing something like 3 trillion euros every year in tax evasion activities. So I think we all need to look into these issues, and your contribution, Professor, has been valuable in that way. As a former Finnish ambassador to OECD, I may be biased to say something about the OECD's role in this question, but I would like to defend OECD a little bit, because it has been the only governmental international organization that has been dealing with the tax evasion, tax havens issue during the past 20 years. And I admit that it has its weaknesses in this sector as well, but their approach in OECD in tax evasion questions, tax haven issues has been, I would call it tactical. If they start blaming these islands, certain islands or places that we know that are dealing not transparently in these issues, just blaming them or building blacklists, it's not going forward. But what the OECD has done very lately is that it has negotiated tax agreements with many of the small islands, and it's going forward absolutely in these questions. It is a slow movement, but most OECD can do with its weaknesses and what the countries are ready. But the process is there and it's going strongly, and what has been initiated now by Finland and the European Commission is very much built on the OECD research and experiences in these matters that are at the same time very issues that are not, there are many vulnerabilities when we discuss these issues. So the beginning has to be constructive and going forward by and by. So I think this is a contribution towards that discussion, very much needed. Thank you very much.
Can I just say, I think we've had three, have we?
It's three.
Yeah. I think I certainly agree with David that industrial policy, economic success cannot be solved just by fiscal incentives. There are 417,000 people on the live register at the moment, 14%. Youth unemployment in Ireland is above 30% in other countries. US multinational companies, according to the ID, employ 106,000 people. If you double the amount of US investment in Ireland, it wouldn't solve the problem. We need alternative and other dimensions. We need to identify and develop indigenous industry. We need to develop strong multinational Irish-owned companies that if there's a problem, they'll innovate in Ireland, they're located in Ireland, they're embedded in Ireland, they've high linkages in Ireland. I certainly agree that tax harmonisation is very useful in the way forward, and I welcome the financial transactions tax. And I think that that is the solution to Google and the taxation of these internet-based companies. And it's not just Google and other companies that benefit from this. Ryanair, for example, pays virtually no tax at all. Corporation tax. Now, if you look at their accounts, they don't seem to pay much VAT either, and their PRSI seem to be absolutely tiny in relation to the size of their workforce. So I think it's, Der Spiegel had an article about Volkswagen and BASF using the Netherlands and Luxembourg. So it's a European python. The focus is in Ireland because Google and Apple and because of the Public Accounts Committee in the UK. But it can only be dealt with. The solution is tax harmonisation. So in relation to the OECD, I think the OECD have done some very good work, but unfortunately it's constrained. The problem is that what they write and what they produce is not interpreted in that way. It's interpreted as, if you like, being the Bible. We're not a tax haven, we're not listed by the OECD, the Irish government, the Irish investment say we're not listed by the OECD as a tax haven, therefore we're not a tax haven. But neither are just the Cayman Islands, nor is Bermuda or whatever. And I think that's rather dangerous. I think that there can be change and there will be change, and I also noticed that significant changes come from the US in relation to disclosure and requirement disclosure that the EU were able to go in after that. But that did not come from the OECD, I think, and I think that was a US initiative requiring disclosure of bank accounts in Switzerland and in other countries.
It was very much in OECD during my time.
Okay, but the US...
Transparency of the bank accounts.
Yeah, but
it started very much there, but you are right in saying that
the US, they actually did it.
Yes.
They actually did it, passed the Patent Act legislation, and then the EU were able to run. And I think that's going to be a huge change in relation to banks. But there's a lot of other activity going on that needs to be addressed other than deposits in banks.
Okay, well, we're getting very close to lunch now, so I'm afraid just one more round if that's okay with you. But we'll have to keep it very short, so if people could keep their comments or
I'll go first. I suppose I have a technical question really, Jen. I must say that's an extremely interesting presentation. But you rightly identify legislation other than the rates as being really part of the problem. Now, what I'm wondering about is, you know, the care and management tiebreaker, we'll call it for want of a better word, which is a problem. That's not unique to Ireland. Have you done any research on how other countries have handled this? Is there a way out of this dilemma, which would be in Ireland's hands? Thanks.
Greetings, guys. My name. Just two quick things. One at domestic policy level. There was an article a few weeks ago in one of the Irish newspapers saying that the IDA had gone on tour in the first few months of this year to the headquarters of the main multinationals located in Ireland. Gone to the US and said, really, what do you want us to do and what can be done Now, that's fine. That is Ireland being promoted, and arguably the revenue have the job of supervision and collection and assessment. And there was the same issue a few years ago with the financial regulator, who had the job of promoting and supervising at the same time the IFSC. That was changed in the recent act. So there is I have no doubt, I mean, that's a reasonable hypothesis to say that if a big American company comes here, the IDA or whoever says, look, if you don't know them already, there are 6 companies, there are 4 sets of lawyers there, whatever, go to them and they look after you. So there's a sort of an Irish dimension to that. But I just want to raise one very quick thing with you as well. Put it simply, is in the 20-year view company taxation on a worldwide basis viable at all, in the sense of the shifting dimension of what globalization is in terms of services, in terms of digitalization, that profits can be so easily manipulated worldwide. It can be here, where is the product made, where is it distributed, how is it accounted for, and is there a long-term future for corporate tax? And then you come back into the incidence issue. Do you have some sort of turnover taxes, transaction taxes, property taxes, registration taxes, and what have you? Now that's a very wide thing. I just want maybe have your quick response on it.
And maybe Prunchis, if you could ask, and then turn it back.
Yeah, very quickly. I just want to know if anybody confirm something I read a while ago, that the amount of tax lost to developing countries actually exceeds the amount of aid that they receive from the rest of the world. And in other words, we are very generous in terms of aid to various parts of the developing world, and yes, some of our tax arrangements at the same time seem to be robbing them. So I just want to know that. Second point is more of a comment. I think as a former member of the European Parliament, I want to emphasise that the European Union is not just the Council, nor even just the Commission. There's also the European Parliament, which has greater powers now. This time last year it approved, for the first time ever, a proposal that there should be a European financial transaction tax. I think 11 countries are currently involved in enhanced cooperation, looking to see can they put something like that in place. 11 member states of the European Union, that is. Ireland is not one of them. I've seen no rationale as to why we're not, because it seems to me that it would make eminent sense for us to be involved in the construction of that.
And the last question.
Tom Healy, just a comment about Northern Ireland. Many of us may be aware that the British decision to reduce the headline corporation tax rate towards, I think it's 21%, is happening by stealth, and of course applies in Northern Ireland. And there, the debate, the economic debate about the future of the Northern Ireland economy, at its core is a call for a lower corporation tax. Now, this has gone a little bit onto ice in recent times, following the decision of the British government not to proceed at this stage. But what's interesting about it is that in Northern Ireland, as in the Republic, there is strong cross-party consensus about the need for lower corporation taxes. And those of us who might question this both from an equity point of view as well as from the long-term point of view, we have a very big challenge here to actually try and move the debate on from where it is at the moment, because all the political parties up there, including pretty much all the political parties down here, are completely set on this issue, and there's no discussing. Sorry.
Yeah.
Yeah, I'll just interpret the first question as the issue relating to tax competition. Tax competition is a huge problem. A multinational company located in the UK can say to the UK government, HMRC, we'll move to Ireland unless we get a particular tax concession. Whilst in Ireland, they can then say to the IDA or whatever, we leave Ireland unless we get a tax concession. So one of the things that's driving the lower and more favourable tax regime for foreign investment is this ability to compete, the ability to play one tax collecting authority off of another. Domestic firms cannot do that, so the tax base gets narrower and narrower. Now, the policy dilemma is that the EU and other parties, other bodies, think that tax competition is a good thing. Tax competition is not a good thing. tax competition is not like tax competition or competition for bread or sausages or milk or something else. Tax competition is a very bad thing on an international level. Yet at the EU, they believe tax competition is a good thing, except in the case of tax harmonisation. Say, oh well, tax harmonisation, that's good, but tax. So look, I think there are serious policy issues there that need to be addressing. So from my point of view, I would say tax competition is not a good thing. It leads to drive to the bottom in terms of tax rates and the passing of taxes onto those people who cannot avoid them for whatever reason. And we deal with the issue about the corporate tax rate. Fundamentally, we need a corporate tax rate. Corporate tax raises a lot of significant revenue for lots of countries. For the US, for 2010, is 10.6% of revenue. Where are you going to get that revenue? I believe you cannot have an individual income tax without also having a corporation tax because of the issue of artificial incorporation. You get people setting themselves up as a corporation, you get a further reduction in the tax base. I think that the incidence issue in relation to corporation tax, this is something that Mike Devereux in Oxford argues, and Jim Hines in the US argue, say get rid of corporation tax and then companies would increase their rate of return on profits, you get a huge amount of investment and you get more employment, and hey presto, the government's giving up this tax rate would fall back and forth. That's complete rubbish. You would not get increased investment by reducing or getting rid of the corporation tax. That's part of the business lobby, and they've been very successful in lobbying that you should get rid of the corporation tax. Absolutely not. Corporation tax must be introduced and maintained. I think that in relation to Finch's question about flows from less developed countries, that's a huge issue. And we in Ireland, by the way, we also benefit from these flows. There's a subsidiary in the IFSC which is associated with Associated British Foods. This subsidiary is a subsidiary of a company called Zambia Sugar Producers. It's the largest sugar producer in Zambia. The IFSC company employs nobody. It makes profits and it pays some tax on those profits. As far as I can work out, the tax paid in the IFSC is larger than the tax paid by the company in Zambia, all to the benefit of Associated British Foods. So I think there's a huge issue relating to taxation of companies within Ireland, but in particular in relation to less developed countries, and particularly in relation to African countries that export minerals in other areas. I think this is an issue that needs to be addressed very seriously, and hopefully the G8 might do something about that. Thank you very much.
Okay, I'd just like to thank Stewart and to thank the rest of you for all of your questions and comments. I'm sure we could have